Welcome. This is the Insider's Edge to Real Estate Investing with James Nelson, the principal and head of Edison Young's Tri-State Investment Sales Group. In this program, you'll learn game-changing strategies to outperform the market. James will teach you how to source, execute, and capitalize on the best real estate opportunities in New York and around the world. Now, here's your host.
This podcast is for educational purposes only and should not be relied upon for investment decisions. The opinions expressed are those of the guests and not their companies. Listeners should not act upon the information without first seeking appropriate advice from an accountant, lawyer, or other professional.
Welcome, everyone, to episode number 205 of the Insider's Edge to Real Estate Investing. I'm your host, James Nelson. Thank you, as always, for joining. And wow, here we are at it yet again. Every week, delivering new content, and we're here to really help you gain that advantage to outperform the market. And today's guest, no exception, we have with us Jeff Edison, co-founder of Phillips Edison Company. He served as a principal since 1995. Currently, he's the chairman and CEO. I really love Jeff's perspective on the retail market, specifically grocery anchored. We went really deep on the subject matter, and I really appreciate his perspective. I know you all are going to get a lot out of this. What's really interesting is that at Phillips Edison, they refer to their tenants as neighbors. So they're really thinking about curating and doing what's best for the companies that are tenants of theirs, but going above and beyond, thinking about how they can really create the best community for them. So Jeff's got an incredible background. He's on the board of trustees for ICSC, which is, by the way, a great organization if you all are not involved. Yes, the focus is certainly retail, but if you've ever been to their conference in Vegas, where I've attended for probably at least 10 years, probably more, you see a lot of different investors, developers, brokers. It's a great way to meet people and have some fun while you're out there. And last but not least, Jeff is, yes, another alum from Colgate. We're going to talk about that. We've now had several Colgate alums on this show, and I always get a lot out of their perspective. So we're going to have a brief word from our sponsor. Before we do that, go to jamesnelson.com. If you haven't signed up for the mailing list yet, every month we have a newsletter that's really geared to help you, and it aggregates the podcast. It shows some of the recent articles we've done, other helpful tips there. So you can also find the show notes there for this episode and how to follow what Jeff and Phillips Edison's doing. We're going to have a brief word from our sponsor. We'll get right into that interview.
A different approach to putting our clients first. Edison Young's Tri-State Investment Sales Group sells multifamily, office, retail, development, and specialty sales throughout the New York metro area. As experienced thought leaders in their industry, our 35-member group is available to help you make informed investment decisions by advising you on your current holdings or identifying new opportunities in the marketplace. Our one unified team is built on an industry-unique platform which promotes unparalleled collaboration and teamwork. We share core values of hard work, integrity, and expertise. We put our clients first, providing tailor-made strategies to achieve superior results. Please visit us at aytristateinvestmentsales.com and follow us on Twitter, LinkedIn, and Instagram at JamesNelsonNYC to learn more.
Welcome, everyone. Thrilled to have with us today Jeff Edison, who co-founded Phillips Edison and Company and has served as his principal since 1995, where he currently serves as their chairman and CEO. Jeff, welcome. Thank you so much for coming on the show today.
Thanks, James. It's great to be here. I look forward to the conversation.
Wonderful. And I do not hide the fact that I am a big fan of our alma mater, Colgate. And I believe you are now at least the fifth person that we've had on this show from Colgate. So sorry it took us so long to get to you, but we've had our friend Dan Hurwitz on, Thomas Campbell, Chad Cooley, who co-founded the Colgate Real Estate Council, and of course our mutual friend and my mentor as well, Paul Massey. So I know we already have a lot in common going into this.
Great. It's awesome.
So with that, so you graduate Colgate in 1982, liberal arts school, for those of you who don't know, up in upstate New York, did not have a real estate degree still to this day, although now we do have a pretty active real estate club there, and I think they are starting to offer some more courses for it. But Jeff, getting into real estate, was that even on your mind at the time, or tell us how you ultimately found your way to the business?
Yeah, when I graduated from college, I really had no idea what I was going to do. I went to business school for 2 years. It was really a business school where I started to see real estate as a place where I wanted to go. And a lot of it's just I love hard assets. I love touching them and working them and building them and all the rest. So that part I think is just a natural attraction to it. But the other part about real estate that is always intriguing to me is how many different parts there are that you got to be good at to be in the business. And it's whether it's on the financial side or raising money, or on the equity side on the raising money, or the debt side raising money, or whether it's the leasing space or managing the properties, building things. I mean, there's just so many pieces to it that I find it that part is attractive to me. So I think that's what really got me excited about it.
Wonderful. But just, and I think this will be helpful maybe to those listening who maybe are entirely new to real estate. I mean, at the time graduating, you said you didn't have any real estate knowledge. I don't know if you had any context in the real estate world. For me, it was fortunate enough that Paul Massey had posted a job position at the Career Service Center. But besides that, I knew no one in real estate. So did you have any connections before, or have any path?
No, I really didn't. I interviewed with my second year at business school. I interviewed with the Taubman Company, and they were starting sort of a program to bring people through the organization into different departments, and then hopefully get into one part of the business over a longer period of time after probably 3 to 5 years of exposure, and that was I just felt like it was a really unique opportunity that I really liked. I also looked at the Trammell Crow because the year I graduated from business school, Trammell Crow was, I think, the largest hirer from business schools across the country, which is kind of an amazing thing. They were
now I see that there's so many of these real estate programs popping up, and I don't know if it's just we're hiring and it's a great business that continues to grow, but it definitely seems like a lot of the jobs are still out there, and so I think that the colleges are really dialing into that. So, Jeff, give our listeners a sense of what Phillips Edison is like today. I mean, you're a publicly traded company. You've been in existence for 30 years. What does this portfolio consist of? I know the focus is on grocery-anchored shopping centers. So maybe you could talk about what that all looks like.
So I'll start with a little story. So we over 30 years ago, it was times of the RTC and things were really tough on the real estate side, and there were amazing opportunities to buy. Things that, because it was, and you could get seller financing because there was so much distress in the marketplace. And one of my friends from Taubman, we were both leasing agents at the Taubman Company. We're talking, we're like, we gotta figure out how to buy this stuff, not, sell it or manage it. Like let's figure out a way to do it. And so we put together our first deal in Virginia that we bought, and it was a grocery anchored shopping center, and we basically redid the entire center. We redid the facade, redid the anchor lineup, leased the vacant space, redid the parking lot and the lighting, and all the things you had to do to kind of bring it up to speed. And this was a pretty distressed property, as you can imagine. And the rest of our story is very consistent. I mean, we continued to do that type of project for a long, for 30 years. And it was that grocer that drives, the traffic and the necessity-based kind of retail that got us excited about it. And, and then, now you wake up and all of a sudden you got 300 centers and you're in 31 states and we're a public company and the rest. But it really was from that first center that we, you have the experience with the Massey Knackle thing. I mean, you get really good at knowing your specific market and how you deal with that market by doing it for a long time and building up, that experience in your team. And then all of a sudden, you can do a lot more. And that's a pretty exciting path over time.
Absolutely. And that specialization and that focus is really remarkable to see when now you look at how much the company's grown over the 30 plus years. What was it that attracted you to retail and specifically grocery anchored?
Well, we didn't have a lot of money, and we were putting it together, and we were pretty confident that we didn't want to get into a business that was very cyclical, because we'd seen enough damage from our, from my days at the RTC where there were major changes in the real estate market, and we as we were looking, we're like, if you think about grocery and you think about necessity-based retail, things have to get really, really bad for you to stop shopping at the grocery store. And so part of it was this security, sort of having less beta in the investments that we made. But we also wanted to be able to grow. We wanted to be able to, add value to that. And that's where the grocery anchored center business was appealing to us. It's also, at that time, and it's become more efficient, but it was a really inefficient market. So you could, if you worked hard at finding opportunities, you could find some, opportunities that were not, perfectly priced. And that, was helpful for us.
I love what you just said about the inefficiencies. That's a big premise of my book, The Insider's Edge to Real Estate Investing, is finding those opportunities where, whether you have an advantage or there's, something that's been overlooked by most investors, clearly being able to source and find those opportunities. So I want to get to that, but I have to, we might be jumping around a little bit on our timeline here, but, when you said that grocery anchored and services and standing the test of time and things have to get pretty bad for people not to go out and shop. Well, clearly COVID was that, if there was ever going to be that stress test. And I don't know if it was before COVID or after. That's, this is maybe when, Amazon was just eating up market share for online sales. I mean, there was definitely a time, and Fresh Direct is certainly still a thing. And, people are saying, well, hey, is everyone just going to get their groceries delivered? And then, of course, Amazon goes and buys Whole Foods. But, I mean, you must have a pretty strong opinion on, what that looks like. And I'm sure there are going to be some people who want their groceries delivered. But what gives you conviction that people are going to always want to go to the grocery store and, pick out their produce, so to speak?
Yeah, I got really tired of retail Armageddon. Because every investor that we talk, it's retail Armageddon. Amazon's coming in; they're going to take over that market, and everyone's going to get their groceries delivered to their to the front door or even in their house. And one of the advantages of having done this a long time is whenever something has changed in our business. It's always been, everyone's thought it was going to be the end of it. And I mean, the most relevant for us was when Walmart came in, because I mean, Walmart was basically not in the grocery business when we started our business. And today they're the largest. They've taken, I think 25% of the grocery business. Online grocery is less than 10%, and 90% of that is in New York, LA, and Washington D.C. When you put it, it's just not taking off the way. Now, everybody, what's happened is the consumer demands that there are times where they want delivery, there are times where they want BOPUS to pick it up at the store, and there are times they want to shop in the bricks and mortar store. And they want all those options. And if you don't give them those options, they're going to find somebody on the grocery side who will. And so what's happened is from our perspective is we've seen this evolution. It is stabilizing in terms of where it's going to happen from a cost standpoint. For the consumer. And as that has stabilized, it's not a lot different than other things that have stabilized similarly on the retail side, the overall retail side. Whether it was the catalog business or whether it was the Walmart's coming in, there's always this extrapolating the growth line to where it's going to take over 100%, and it never does, because the consumer does like choices. And if you look back at our history, we experienced the Walmart coming in, and we made the basic decision and belief that the consumer is going to support the first and second grocer in their market, regardless of how good Walmart gets. And so that really was part of our strategy, that what we buy is the number one or two grocer in the market, because we think there's less exposure to the internet, to the Walmarts of the world, to the Aldi's coming in with at a very low end. All those pieces have helped us to develop our strategy. So we were facing retail Armageddon. It's a lot harder business than people think. So Amazon and Amazon really has not proven themselves in the bricks and mortar retail business. They've got, they've closed more concepts than they've opened, and they continue to be really strong in delivery, but they are not. They're not great at yet. They will be probably at some point, but they're not great yet at really being a good bricks and mortar retailer. And part of it's just cost. I mean, it's so expensive to deliver the last mile to people's house that the customer's got to pay for it, or it's not going to happen. And most customers are not willing to pay $15 to have their grocery delivered. So it's going to be that. It's going to be interesting to see how it evolves.
Yeah, I wonder if how that also applies to Whole Foods, and if that's been a successful venture for them. Not, I mean, I don't know if there's a parallel with what we saw, some of these digitally native brands that then went to bricks and mortar, and then they call it omni-channel, so you can buy online, you can return there, whatever. So I don't. It's not exactly how. Grocery shopping works. But I wonder if, that those options that you spoke of, if the other grocers, if that's had as big of an impact for them, where they say, okay, I want our customers to be able to come here and shop, or we can have their order ready, or if they want, they can deliver. And if it's the latter, then maybe they're just, relying on Instacart or whatever it is to bring the stuff to them. But do you think that Amazon and Whole Foods acquisition has proved out as positive? And then do you see some of the other grocers kind of following suit?
I think it has not turned out very positively. I mean, I think that Amazon is very disappointed with their inability to be a more dominant player in the grocery business. Because for them, the 1.7 times a week that people go to the shopping center is their brass ring. I mean, if they could have every customer in the United States come to their store 1.7 times a week, think of all the things they could add on to that and reduce their costs of delivery, reduce their costing. So they want to be really good at that. But their new stores that they opened, I mean, I think they've closed more of the new stores than they've opened at this point, because their Fresh Direct, that was going to be their thing, and they were going to tie it in with. So it's they will continue to work at it, and they'll continue to try and figure out how to make it work. So far, they haven't. They haven't even. I mean, they tried books. They've tried a lot of different things to where they tie in their online. And it's there's a lot of people out there who would say it's much more difficult to go from bricks and mortar to go from internet only to bricks and mortar than it is the other way around.
Right.
And Walmart's kind of, I think, proving it. I mean, they're consistently taking market share and moving up on the internet and delivery side. Mm-hmm.
So it would seem to me then that most of your grocery tenants, and I noticed you call your tenants neighbors, right? So your neighbors would seem to me that they're seeing their customers shop there in person, and I don't know if that's more than 1.7 times per week, but I would imagine that the benefit of having that grocery anchor is obviously once the person's there, and whether it's even to pick up, a half gallon of milk or, whatever it is, that they're there. And then if they got to get their dry cleaning or whatever else, but, how much of that, kind of benefit do the other tenants in the shopping center get from that, shopper or having that strong grocery anchor?
It's a very integrated and a really important thing for them. And I call it sort of the Saturday morning decision, where you've got a bunch of things you got to get done, and where you're going to get them done. And you want to get a workout in, you want to get your hair cut, you want to get your nails done, you want you want to get a smoothie, and then you got to get some groceries for dinner. And we want to be where your mind goes. That's where I want to be. And then we want to merchandise the center so that we have the best of each of those categories for you. So we have the best nail salon. We have the best place to get reasonably priced haircut. We have the best place to where you might want to go to dinner on a casual place on a Friday evening or a Saturday evening. Like that. That's what we want to provide the best of in each center that we have. And it's and I actually got a lot of this from Massey NACO, which was that block by block kind of concept, and being really locally smart. That to us is the key to our being successful in our business, because we have 300 shopping centers, and they don't compete with each other. They don't compete in regions. They don't compete, in the Southwest or Southeast. They compete in a 3-mile radius, and we have to be the best operator in that 3-mile radius to win. And we've got to have the best anchor, and then we've got to have the best merchandising of our centers. And that, getting smart, neighborhood by neighborhood, is what we think has allowed us to, be successful over a sustained, period of time.
Wow. Okay. So that leads to a lot of interesting follow-up questions. So first of all, the idea of getting best-in-class tenants, but then kind of weighing that against the highest rent. So I'm sure you've had this happen. You probably have this happen every single day, where you have some startup concept and maybe it's the latest, fad or whatever it is, but they come in and they're willing to pay a really big rent. Maybe the credit's there, maybe it's not, versus the, maybe the other, if we're saying the hair salon, you have them and maybe it's a chain, or maybe you have them in another location. So how do you make that decision where on one hand you are trying to maximize value and you're trying to get the best rent, but you also want the best operator? And I think what I'm hearing you say is it's got to be the right fit for the center. You want to have the right tenant mix. So how do you weigh that all?
Yeah. We have one thing that really helps us, is that we get sales information from our retailers. And the way we kind of equate it is if somebody is a great retailer, they're going to do really good sales. That by definition, it's almost the definition of being a great retailer. I mean, you can't be, like at the high end, Louis Vuitton, they wouldn't be great if they didn't have really good sales. And that is that customer wants to buy that product. Well, it's the same thing on a much simpler scale at what we do. I mean, if your nail salon is the best nail salon, you're going to they are the one that you can get the best rent from, for us as an owner, but also for them as a merchant, and then for the customer, ultimately for the customer who wants the best of that category. And we, whether it's fitness or whether it's fast food or whatever, we're constantly looking for the ones who can who are the most profitable, because the most profitable can pay us the most rent. And we're, unlike some of the office and so on, like we are a direct part of their business in a way that retail is. I mean, you have to be, you got to be in a location that draws the customer, so that you're helping the retailer be more successful. And that is a big part of what we're doing.
That makes a ton of sense. So now I want to talk about And this is really interesting to me, that this idea of, okay, you want to be the best center within a 3-mile radius, right? So it's almost, so I would assume with that, you're clearly not buying centers that would cannibalize each other, but you see an asset that you want to buy, and maybe this is a good example, or maybe it's not, but let's say that you're looking to acquire the shopping center that is not performing at its highest level. Maybe it's got some vacancy, maybe it's been mismanaged, but a mile away is the powerhouse, the go-to. It's got all the tenants that you want in your portfolio.
Yeah. Right.
So are you ruling out that value add opportunity to kind of turn around, or you say, hey, we know how to do this, we could do it better. This is, basically war, and we're taking on this other center. Is that, I don't know if that's the right question to ask, but it's almost thinking about, like, what's the competition, when you go in to buy that asset, and are you going to say, you know what, this other center is just stealing all the action, and we don't want to go head to head with them. Let's go find something else where we can be best in class, or are you willing to kind of make that long-term proposition?
It really revolves for us around the grocer, and if we have the number 1 or 2 grocer, we're highly confident we can win in the market, and that means that's against anybody. I mean, but if you don't have the number 1 or 2 grocer, then you're taking, you can, there still is a place for that, but it's not where we play. We play in the number 1 or 2 grocer, and we expand that a little bit. I mean, we've got a lot of Trader Joe's that are probably not truly 1 or 2 in the market, but they do bring a tremendous amount of traffic and volume, so they work really well in that environment. If we have a center that, if that B center that you're talking about, or C center, has the opportunity to bring a grocer into it, that isn't there, that we know through our sort of long-term relationships that we do, that's a great opportunity for us. But it's not, there aren't that many of those, versus the ones where you're finding a sort of a mispriced or mismanaged center with the number 1 or 2 grocer.
Mm-hmm. Jeff, how many states did you say that you operate in again?
31.
Okay, 31. So you've had experience in a lot of different regions, I would imagine. So what is the common denominator, if there is one, on where you're going to have success? So again, you're dealing with a bunch of different municipalities and rules, and I don't know if there's a certain size where if you don't have a certain population within that 3-mile drive. I mean, how do you know what your target is? And then kind of what are the attributes of those geographies that you're looking for, that hopefully I would assume you're looking for it to grow, right?
Yeah. So it starts with the analysis of the trade area, right? So we've got the 1 or 2 grocer we know in that trade area, and then we know what their sales are. So we know that they're either being successful in that market or not being successful in that market. If they're not being successful in the market, unless there is a lot of change going on, it's probably not a center that we're gonna jump into. But if it is, if it does have the right sales, and sales in grocery are kind of a little bit, you have to be careful about, because it's not just gross sales, it's sales of the most profitable parts of their business, which is basically the outside of the grocery store. If you look at the stuff that the perishables, that's where they make their money. The other stuff is very, I mean, the margins on the other, Campbell's soup is really tight. So, they can sell a lot of Campbell's soup, or they can sell one, thing of lettuce and make 10 times as much profit. So you do have to look at sales in terms of where it is in the store and the profitability of that. But once you have that, then this can be, we find better markets in Omaha than we do in New York City for our business. It's some.
And why is that, Jeff? Is there just maybe there's less competition? I mean, New York is such a expensive, competitive market, and maybe Omaha, you don't have as many choices? I mean, is it?
Well, you got you're competing with 10 grocers in a 3-mile radius versus one other one. Mm-hmm. Okay, and your competition is significantly different. If you bring the national tenants into some of these secondary markets, you do bring a level of excitement, and it's you bring a Chipotle into New York City, it's like care less, right? I mean, they're 10 better in around. You bring that to you bring that to Cincinnati, you bring that to Columbus, you bring that to Orlando, you bring that to it has a much more positive impact. Starbucks, you only have four every block in New York. But they haven't built that whole infrastructure out, in the suburbs, and that's where we can bring those players in, and then. Again, we're bringing more people. We're making it a more attractive place for shoppers, and then we can grow the value. And so we don't have a lot of centers in really small markets because that gets really hard. And there aren't options for you if they're really small markets. But there are secondary markets where we have been really. Have been really successful for us, and that's and that inefficiency you can find in those markets is phenomenal. But our biggest state is Florida, but we're not just in Miami. We're also in Tampa, we're in Orlando, we're in Jacksonville. We're in multiple markets, and Atlanta's not considered. A top tier market. Well, it is, and it's crazy not to be. And we're, but our Atlanta's, Atlanta's probably our second largest market in terms of concentration.
Mm-hmm. So, I would have to imagine you have 300 centers, you have 5,500 tenants, neighbors.
Yeah.
That's got to be a huge competitive advantage for you because, and I don't know how many Trader Joe's you have. You might, know off the top of your head, but I've got to imagine if you're looking for a center and Trader Joe's is not there, it's probably very easy for you to call whoever the head is of real estate there to say, hey, is this something that you're interested in, and have that knowledge going into it. So, how much are you leveraging or I'd say capitalizing on that knowledge, understanding, and having those tenant relationships? That's got to be one of the most important parts of your business to have success, right?
Yeah. And when you've sort of done what you were going to do, what you said you're going to do to your anchors over a 30-year period of time, you build those relationships, and you build them all the way throughout the organization. So but the place where they help us the most, and occasionally we get a center where they want to be, and they can't get along with the owner, and they need to get a new store built, and we will come into those situations, and they will bring us into those situations. But the most important part about the relationship is when we're buying properties, to be able to talk to them and have them help us to say, look, that's a very profitable store for us, or no, I'd stay away from that one, and because that is. But we've earned, I think I kind of feel like we've earned that, because we've done a lot of things for them over time to help them, make sure that their stores are successful, and that wherever we can, giving them the best access, giving them the best visibility, making sure that they're, that we're surrounding them with really good merchants that will encourage their sales, not necessarily conflict with them, and so that's a big part. Has been really helpful for us, and because we're in 30 states, we kind of deal with all the grocers.
Jeff, I'd love to expand on this point because it's so important. And whether, our listener, maybe they don't have any plans to, go and buy a grocery anchored center. Maybe it's even just their multifamily, their tenant relationships or whatever it is. But how important it is to have that tenant relationship? Because I'm sure this has happened to you multiple times where maybe there is that competitive site that was in your 3-mile radius and they sell the site and the tenant, whoever the new landlord is not as hands-on or friendly. And they say, Jeff, this isn't working out so great for us. We'd love to join you. Right. So I've got to imagine that comes back to you, but, and you talked about what that means to be a good landlord. And I think you said to give that visibility, but how do those discussions go? What separates you? And is it really being hands-on and being responsive? Is that really kind of how you differentiate yourself?
Yeah, I think the way I describe it is we have an organization that has scale, but our people think like owners, and they know how important each one of our neighbors is to us, and so they treat them with that in mind. And it doesn't mean that we don't have tough discussions and like the things you have to do as a landlord, but you're really looking at building a neighborhood. You're building something that where each neighbor helps each other, the other neighbors, not physically help, but help them by drawing their customer and being really good at what they do. And if you can do that, everybody benefits. And we do have to make the hard decisions too, which is equally important to the neighborhood. I mean, that is part of being a really good landlord. It's not just saying yes to everything, because you actually, there are places where we're pretty strict in terms of signage. That's just an example. But if somebody puts up crappy signage in their stores and you let that stay, well, that creates an image of the entire center, which affects all the rest of the neighbors too. And so there are things about being really hands-on and making sure that you are focused on creating that right shopping environment that I think is really it builds that loyalty. And then the other part is you got to do what you said you're going to do. And you can't say, oh yeah, we'll take care of that, and then all of a sudden it's 6 months later and you haven't done that. That's an important part about it. And for our national guys, it's building relationships throughout the organization, not just at the at the store level, which is really important, but also at the corporate level and being able to have those relationships over time.
Jeff, I'm really glad you expanded on that, because I know that'll be super helpful to the audience, and really, again, doing right for the property and doing right for your, the tenants, the neighbors in your property. It's this so well. It's not a one-way street. I mean, if you're not working together, you're there are adversarial points, and that is part of the real estate game. But if you can look at it from both perspectives, our driver here is to get our retailers to do the best sales they possibly can, because that gets us in a position where we can get the best rents, and that's a win-win. Wonderful. So Jeff, now I'd like to talk about how you went about growing Phillips Edison, right? So you talked about your first acquisition, and then, and I would assume maybe along the way you were raising private capital. Maybe it was the friends and family, and you clearly really scaled this business. Now, I don't know if this was, and I know you did spend time at HBS, and so maybe it was out of that playbook, but was it always your vision that you were going to scale, maybe go public one day? Was this kind of all part of the plan, or talk a little bit about the growth of your company?
Yeah. So the first one was, we actually, Mike and I had bought a property in Detroit before, way before this, that was in Birmingham. So it was a single store in a more downtown environment. It was suburban downtown, but it was a downtown environment, and we done well on it, and that was great. But that was sort of the formation of, we want to own, like, we'd rather be owners than than any other part of the process. So the first deal we put together was my dad a friend of my dad's, Mike, and myself. And Mike and I were always among the biggest investors in what we did. We always wanted that. We felt that was like really important. And then we bought a second. In the second one, we had to go outside because it was a little bigger. We had to get, we started going friends and family, and we did that for about 10 years. And then we ran out. We like to say we ran out of friends, and we wish we had had more friends. But it was we did keep that going, and then so we were very lucky because we kind of got in when the CMBS market was just starting. I think we were in Morgan Stanley's first CMBS sale. So the first commercial backed mortgage portfolio, and what that allowed us to do was to get all of our money back with a return for our investors and to hold the property. And this was 10-year money, so it was like we could do that. And we would buy these properties, we'd turn them around, and then we'd put CMBS, get your money back, and keep going. And that was really the 10-year process. And then we started a fund, our first institutional fund, and we were extremely lucky to get the government of Singapore to be the lead on it. And then we got with them a number of other very strong partners, and a big Dutch pension fund, so that was our first sort of institutional fund business. And we did first one, we did a second one, and then we hit the great financial crisis, which honestly was probably more difficult even than the pandemic. It was a pretty brutal time for everybody on the real estate side, and we'd raised that money. We were told our lead investors told us they didn't want to invest anymore. They would, they were obligated to, but they didn't want to. So we had to close our second institutional fund off early. And we're sitting there like, wow, this is going to be a real opportunity time, but it's also going to be a really difficult time to raise capital. And we got into the non-traded REIT business, and we raised a bunch of retail money, and we raised almost $3 billion of retail money. And that gave us another step on the growth curve, because that was the stage that took us to where, we got to where we were of a scale where being a public company was a real option. And we were one of the non-traders that made some, really good money for our investors. So they've stayed with us now, through the IPO and the rest. But they also have full liquidity now, which we promised them we were going to do, and we kind of lived by what we said we're going to do. And they made a really nice return on it. And so that worked out, great, and we were very, that got us to kind of where we are today as a 3-year. We've been in public for 3 years, and continued to keep that the culture and the focus that we have in the company, but with access to additional capital that we didn't have before.
Mm-hmm. So, Jeff, like Paul, you're incredibly humble, and I'm listening to this saying, and then we raised a retail fund, and we had $3 billion. I'm sure that didn't just happen. I mean, the amount of work and to go out and reach the retail investor, because I'm sure you're not going to tell us that the average ticket size on that was $500,000. I mean, I don't know.
35,000.
35,000. Okay, so I can't even do the math in my head, but that's a lot of investors. So how do you?
We had 60,000 investors.
60,000 investors. Okay, so and this should be really interesting for our audience, because I'm sure in order to do that, you had to have the platform first. You had to have the track record, right, to attract that. But then, how do you go out and find 60,000 investors?
Yeah, we ended up with a partner who helped raise that for us. So it was a sort of a joint deal between, getting somebody who could access the retail investor. But it was a very intentional thing on our part, because over time, the retail investor has taken on an increasing control of their own capital. It used to be, you got a pension fund, and the pension fund was managed, and if you're in the real estate business, you go to the pension fund guys and you invest their money of their pensioners. And but as you've gotten into 401ks, you got into people having to control their own savings. Our feeling was that the retail investor was going to increasingly be a driver of capital, and that's when we got. That was one of the things that got us into deciding that was a place where we could find a good capital and opportunity. But as you said, it was very expensive to get in, and it took a long time before we started raising any capital. So these are not like you turn them on. I mean, this was year and a half, probably $15-20 million invested in. Starting to raise the money before we actually started raising any money.
Got it.
So yeah, it wasn't. there were some, so to speak, there were some sleepless nights about we were like, when is this going to start actually raising money?
Yes, I wanted to ask the question because I knew it wasn't just a matter of flipping the switch and then $3 billion landed out in your account.
No, it was
and just to be clear, when we talk about retail investor, and I don't know if with the terminology of accredited investor, is that when you define the retail investor, who are you speaking about there?
Yeah, I'm talking about like everyday Americans who have a savings, and they usually use a financial advisor, but some do it themselves, and they have a financial advisor who helps them to run their 401k and to run their their savings, so that they hopefully have some money when they retire. And that's what we're talking about for the retail investor.
Got it. So Jeff, and maybe then this was your partner who had the relationship with the investment advisors, I think the RIAs, right? Yeah. And so was time spent then to, I guess, cultivate those relationships, again, if this was new, to introduce them to the opportunity. So I guess that's kind of question one. And then the other part is, and for those advisors listening to the show now, or the retail investor, how do you know you want exposure to real estate? I mean, I think what you're saying about grocery anchored, I know what you're saying, makes a ton of sense, but I'm sure there's other options out there as well. Other companies that are doing the same thing. So how do you, as the investor, how do you diligence these? How do you figure out what sounds good? And most importantly, how do you know that you're dealing with a trustworthy and capable sponsor?
We got a lot of credibility because we'd been around for a long time, and we had investors, and friends and family really is just retail investors, but they're that. So our roots are in that, and our roots are in making sure that we make money for them, and it's we're making money for ourselves too. Don't get me wrong, but making sure we make money for them, that's a really important thing. And if you invest with people who see that as their objective, you got a much better chance of it being successful. They won't all be successful, but you got a much better chance of that happening. And we had a track record that was strong. And, reputation was good, but we also had a product that our investors really understood. So when we started, and it's sort of that Warren Buffett thing, which is, invest in things you understand. And, when we would talk to the retail investor and say, okay, where do you go on Saturday morning when you got to get your necessity-based stuff done? Where do you go to grocery? And like, we got through. And you're like, is that a Publix, or is that a Kroger? Is that a Safeway? Like because and they would be like, yeah, I see what you do. You go to those centers. Well, that was helped us a lot because the investor understood what we're doing, and we see that as hopefully something that it has continued, and we want it to continue to happen, which is that when they're investing in our public stock, it's the exact same thing. They're investing in a company that has been around for 30 years, that has a very focused strategy, and a strategy that's kind of understandable for the average consumer because they experience it. Mm-hmm. And by the way, we are Kroger's largest landlord. We're Publix's second largest landlord. So we are in those markets where these investors they understand what they're doing.
Mm-hmm. So, Jeff, as we start to near the end of our time together today, would love to hear about your ethos, the way that you run your company. I mean, obviously, you've been doing this for 30 plus years. I've got to imagine your people are a big part of that. So talk a little bit about how you actually built the company and the culture.
Yeah. Well, the story I will start with is our president in June retired. He'd been with us for 10 years. Devin Murphy, you may know him. He's one of our.
I've heard that name for sure.
And his replacement has worked for us for 20 years, over 20 years. Bob Myers. Bob's replacement had worked for us for 20 years as our chief operating officer. The length of time, I mean, we've kept the band together for a long time, and we are huge believers that every center we buy, we learn something from. And if we can keep that knowledge in the company, we just keep getting better. And what that does is it makes it harder for our competitors to keep up because we're constantly changing, we're constantly trying to improve, and we like to win. Like we really like to, when we say like we like to win at in that 3 mile radius, we want all 300 of our centers to win, and that's a fun. It creates a really fun environment to where we're going to win here, and that is what we've tried to build within the organization. Every one of our associates has stock in the company. It's part of our strategy and has been forever. Because we want you to think like an owner. And if we want you to think like an owner, you better be an owner, or it's just academic. But everyone in the company is an owner. That's been like an important part. And we have some sort of baseline things that are really we think are really important. One is we assume good intent of every associate in the company, and when you start with that belief that everyone's trying to pull the oars in the same direction, it's really helpful. We are violently against any kind of triangulation, and our thing is like, if you're not allowed to talk about somebody else unless that other person is in the room with you. And then you can talk about everything you want, but that's a core sort of strategy of ours, because if we think of gossip and that stuff as sort of a cancer, and we're gonna like cut it out wherever we can, and that's a big thing for us. We're big on over communicating. We believe that like 90% of the problems that happen in an organization are lack of communication. Because if people are all trying to do the right thing, it's emotional things. It's like, and so you gotta really work on that part of the communication. And then the last piece is we believe we're in a really competitive business, but we're very focused on the fact that the competition is outside the four walls of the company. We don't compete internally; we compete externally, and we got to win. Where we want to win is not some internal battle. We want to win by being the best out there against the competitors that are outside the company. And that, those are like kind of simple things, but they have long-term impact, and they're hard to keep pushing on, but they do, I think, have a long-term benefit. And part of when you look at the retention we've had of our senior management team, there is something to it that we think is good. And we've received a lot of awards for the best places to work. We've received a lot of awards for the best having the best health program in the what was in Cincinnati, but we just got one for a national award, top 10 in the country, for healthiest places to work. So we do work at these things beyond just the like compensation and thing. It's a focus on building something that's long term. And I get back when I was at an ICSC meeting with the young. I can't remember the name of it, but it's basically young. It's the young
emerging leaders
in the ICSC world, and we were at a convention, and one of the questions is, so what would you recommend? Like, what was the driver for you? And I really love to build things, and whether that's real estate or whatever, but our greatest accomplishment is building the PICO team. And building that over a long period of time and continuing to kind of try and improve it.
Oh, that's wonderful, Jeff. Well, that's a great way to end, and we appreciate it so much. You're taking the time today and sharing about what you've been able to accomplish as a team. And I think that last piece and the culture, but having fun, but also playing to win. I mean, let's not forget. That's important. So Jeff, we really appreciate your coming on and sharing your story. So thank you again.
Good. Well, thanks, and hopefully we'll get a chance to get together in New York sometime soon.
Absolutely. I look forward to it, and thank you everyone who joined us to listen, and I know you got a tremendous amount of benefit out of this, so share it with a friend. It's a great way for this episode. That's what we're out there, is to help you all gain the insider's edge to real estate investing, and this was a great conversation. So thank you all for joining. Until next week.
Thank you for listening to the Insider's Edge to Real Estate Investing. We appreciate your subscribing and sharing with your friends. If you haven't already, please connect with James at James Nelson NYC on LinkedIn, Instagram, and Twitter. Please also visit jamesnelson.com, where you can find the show notes and other episodes, along with an exclusive video series and other helpful resources, so you can gain the Insider's Edge to real estate investing. Until next week.